In this podcast episode, Anthony Pompliano, a well-known figure in the finance and cryptocurrency space, shares his insights on the evolving landscape of investing and the implications for traditional strategies, particularly those championed by Warren Buffett. The conversation delves into various topics, from the changing nature of the economy to the role of technology and the future of investing. Pompliano begins by addressing the fundamental shift in investment strategies that is occurring over the past few decades. He emphasizes that the traditional value investing approach, epitomized by Warren Buffett, is becoming less effective in a rapidly changing economic environment. The rise of technology and the increasing importance of digital assets create a landscape where investors must adapt or risk being left behind. He argues that the old playbook, which focuses on buying undervalued companies with strong fundamentals, is no longer sufficient in a world where innovation and disruption are the norms. He points out that many investors are now gravitating towards assets that are not only resilient, but also have the potential for exponential growth. This includes technology stocks, cryptocurrencies, and other digital assets. The conversation highlights the need for investors to embrace a more dynamic approach, one that recognizes the importance of timing and market sentiment, rather than solely relying on traditional metrics of value. One of the key strategies Pompliano advocates for is dollar-cost averaging, particularly in the context of investing in the S&P 500, NASDAQ, and Bitcoin. He explains that this approach allows investors to mitigate the risks associated with market volatility by consistently investing a fixed amount over time, regardless of market conditions. This strategy not only helps in building a diversified portfolio, but also instills discipline in investors, encouraging them to stay the course even during turbulent times. Pompliano emphasizes that for the average person, this method is particularly effective because it removes the emotional aspect of investing. By committing to a regular investment schedule, individuals can avoid the pitfalls of trying to time the market, which often leads to poor decision-making. He believes that this disciplined approach can lead to significant long-term gains, especially as technology continues to drive market growth. The discussion then shifts to the concentration of wealth within a small number of technology companies, often referred to as the Magnificent Seven. Pompliano notes that these companies are driving a significant portion of the market's returns, leading to concerns about the sustainability of such concentration. He argues that while these tech giants have proven resilient, the increasing reliance on a handful of companies raises questions about market stability and the potential for future disruptions. He also points out that this concentration is not just a phenomenon in the stock market, but is mirrored in the broader economy. As technology continues to reshape industries, the disparity between those who benefit from these changes and those who do not is likely to widen. This, he suggests, could lead to increased social and economic tensions, making it imperative for investors to consider the broader implications of their investment choices. Pompliano is a strong proponent of Bitcoin, viewing it as a critical asset for the future. He discusses how Bitcoin's unique properties, such as its scarcity and decentralized nature, position it as a viable alternative to traditional fiat currencies. He believes that as more individuals and institutions recognize the value of Bitcoin, its adoption will continue to grow, further solidifying its place in the financial landscape. He also highlights the potential for Bitcoin to serve as a hedge against inflation, particularly in light of the increasing money supply and government spending. Pompliano argues that as central banks continue to print money, the purchasing power of fiat currencies will diminish, making assets like Bitcoin more attractive to investors seeking to preserve their wealth. This perspective underscores the importance of diversifying one's portfolio to include digital assets that can withstand economic fluctuations. The conversation takes a turn towards the implications of artificial intelligence on the job market and investment landscape. Pompliano expresses concern about the rapid advancements in AI technology and its potential to displace a significant number of jobs across various sectors. He notes that as AI becomes more integrated into the workforce, many individuals may find themselves struggling to adapt, leading to increased economic inequality. However, he also points out that this disruption presents opportunities for investors who are willing to embrace change. By identifying sectors that are likely to benefit from AI advancements, such as technology and automation, investors can position themselves for long-term success. Pompliano emphasizes the importance of staying informed about technological trends and their potential impact on the economy, as this knowledge can inform investment decisions. As the discussion progresses, Pompliano addresses the future of value investing in light of these changes. He argues that traditional value investing, as practiced by Warren Buffett, may not be as effective in a world dominated by technology and rapid innovation. Instead, he suggests that investors should focus on identifying companies that are not only undervalued, but also have the potential for significant growth driven by technological advancements. Pompliano believes that the key to successful investing in the future lies in understanding the underlying trends shaping the economy. By recognizing the importance of technology and its impact on various industries, investors can make more informed decisions that align with the evolving market landscape. This shift in perspective may require a departure from traditional metrics and a greater emphasis on growth potential. Another important theme in the conversation is the psychological aspect of investing. Pompliano highlights how emotions can significantly influence investment decisions, often leading to poor outcomes. He stresses the importance of maintaining a disciplined approach and avoiding the temptation to react impulsively to market fluctuations. He suggests that investors should focus on developing a long-term mindset, recognizing that short-term volatility is a natural part of the investment process. By cultivating patience and resilience, individuals can better navigate the ups and downs of the market, ultimately leading to more successful investment outcomes. This psychological resilience is crucial in a landscape where emotions can easily cloud judgment. Pompliano also emphasizes the importance of financial education in empowering individuals to make informed investment decisions. He argues that many people lack a basic understanding of financial concepts, which can hinder their ability to navigate the complexities of the market. By promoting financial literacy, individuals can gain the knowledge and skills necessary to make sound investment choices. He suggests that educational initiatives should focus on teaching practical skills such as budgeting, investing, and understanding market dynamics. By equipping individuals with these tools, society can foster a more informed and engaged investor base, ultimately leading to better financial outcomes for all. This emphasis on education aligns with the broader goal of promoting economic empowerment and reducing inequality. The conversation also touches on the role of government in shaping the economy and its impact on investment strategies. Pompliano argues that government policies can significantly influence market dynamics, often creating opportunities or challenges for investors. He emphasizes the need for policymakers to consider the long-term implications of their decisions, particularly in relation to technology and innovation. He expresses concern that overly restrictive regulations could stifle growth and hinder the development of new industries. Conversely, he acknowledges that thoughtful policies could foster an environment conducive to innovation and investment. This delicate balance underscores the importance of collaboration between the private sector and government in driving economic progress. As the discussion nears its conclusion, Pompliano shares his thoughts on the future of the stock market. He suggests that the market is likely to continue evolving in response to technological advancements and changing investor preferences. This evolution may lead to the emergence of new asset classes and investment vehicles, further diversifying the landscape. Pompliano also notes that the increasing popularity of alternative investments, such as cryptocurrencies and digital assets, could reshape the traditional stock market. As more individuals seek exposure to these emerging assets, the dynamics of investing may shift, requiring investors to adapt their strategies accordingly. This ongoing transformation highlights the need for flexibility and a willingness to embrace change in the investment world.